Okay, folks. In case you need a reminder, your case is due exactly a week from today. So if you haven't looked at the case, that's just the reminder, right? It's due before class, because in class we will be talking about the case. It's due by 10:30 on next Wednesday. So so if you're working on the case, actually these two sessions and perhaps even the Monday session, especially today's session, you're going to see stuff come up that's at least mildly familiar, which might help you on the case. So let's get started. We left off by looking at two ways of computing time-weighted incremental cash flow returns. The first is net present value, right? This is what you're taught in every foundations class. Well, what do you do? You take every cash flow, you bring it back to today using the discount rate you pick to get the present value. Add up the present values of all of your cash flows, including your initial investment, and what you get is a net present value compared to zero. So remind me again why net present value of even $1 is okay on a $10 billion project. That seems like very low returns, right? Why is a net present value that's even very mildly positive still a good project? Shouldn't I be asking for a $5 billion? Yeah.
Because it's compared to your cost of capital.
Because it's over and above your cost of capital. It's excess value. So when I say I'm making a net present value of $1, I'm not saying I'm making $1. I'm saying I'm making my cost of capital, which is 8.46. Would you rather have a $1 billion net present value? Of course. But beggars can't be choosers. Remember what we said when we saw that graph of returns on capital versus cost of capital? What did we see? A lot of companies have a tough time earning their cost of capital. If they can earn a net present value of $1, they're winning because they're doing much better than they're doing right now. So of course everybody likes to have big positive net present value projects. But if your choice is nothing or a net present value of $1, I'd much rather that you take a project with a net present value of $1. The second time-weighted incremental cash flow approach is you solve for that discount rate that makes your net present value zero. A lot of people who use internal rate of return, which is what that discount rate is, often use it because they say they don't want to go through the pain of computing the cost of capital. And it's painful, right? You have to pick a currency and a beta and a risk premium and a default spread and bring them all together. So that's too much work. I'm just going to do an internal rate of return. What are they missing when they say that? After you computed the IRR, what do you have to do? You have to compare it to something. All you've done is delayed that process till after you've computed the IRR. And that's not really going to save you the trouble of computing the cost of capital. But the choice, again, is your internal rate of return is greater than your cost of capital. You will take the project. So let's bring those tools to play to the Disney theme park. Let me remind you where we are in our analysis. We ground through the accounting numbers, and we concluded based on an accounting return on capital that the project did not do well, right? Its return on capital is about 4.18%. The cost of capital is 8.46%. But before you rejected the project, I threw this note of caution, which is I stopped after 10 years, and this project is probably going to go on for a much longer time period. With accounting returns, there's not a whole lot I can do about what happens after year 10, unless I want to do year 11, year 12, year 13, etc. But with incremental cash flows, there is something I can do. And here's what I'm going to do. I'm going to assume that my cash flows are still going to stop in year 10 because I don't want to keep projecting out cash flows. But I'm also going to assume that after year 10, the cash flows will continue to grow at the inflation rate forever. Let me take those two parts. Why the inflation rate? Because I'm essentially going to assume that Disney is going to be able to raise ticket prices the inflation rate, but that the number of tourists coming into the theme park are going to level off in year 10 levels. Why am I not letting the number of tourists also grow? What's the problem with doing that? So if I let the number of tourists in year 10 keep growing at 1% a year, for instance, forever, there are going to be more and more tourists in the same theme park, right? So if I do that, what do I have to do to kind of reflect the fact that I have more tourists? I have to expand the theme park, I don't want to do that. So essentially I'm saying I'm going to keep the theme park the way it is. I'm going to maintain it because remember I put maintenance capex in to make it looking okay. But the number of tourists is going to level off in year 10 and then grow at the inflation rate forever. I actually presented this to a group of Disney theme park managers, and their first reaction is, we know our theme parks last a long time, but they don't last forever. And I said, just hang in there, because let's see what we get if we assume it lasts forever. It becomes a growing perpetuity. Remember the types of cash flows. A cash flow that grows at 2% a year forever is a growing perpetuity. The present value of that growing perpetuity is the cash flow in year 11. It's always 1 year past your final year, which is 715 million, year 10 cash flow growing at 2%, divided by the difference between the discount rate and the growth rate, gives me a gigantic number, 11,275 million. I'm going to call that my terminal value. As opposed to what? If you have a project you wrap up and end, you get what's called salvage value, which is basically you sell everything on eBay, you collect whatever you can, that becomes the end of the project. A terminal value is a word we use when we allow the theme park to keep going. 11,275 million. So that's assuming forever, right? So then I turned to the manager and said, it's not going to last that long. I said, how long does the theme park typically last? He says about 50 to 60 years. Remember the growing annuity formula I showed you? Where I said if your growth rate is constant, there's an equation I can use. I could have made this a growing annuity for 50 years instead of forever. And if I put a 2% growing annuity for 50 years, you know what this value would have been? It would have been about $11.1 billion. The reason we use perpetuities all the time in valuation, and we do this all the time, is not because we're hopelessly optimistic about the future of the world. It's for convenience, which is if your life for the project is long enough, you might as well use a perpetuity assumption. It's much easier to work with than assuming that your project will last an extra 70 years or 80 years. So this 11,275 million becomes the value of all cash flows beyond year 10. I'm ready. I have all the cash flows I need, and those are the incremental cash flows. I took out the sunk costs and corrected for the allocated G&A. And in year 10, I put this gigantic number, 11,275 million, as if I'm getting it in year 10. Now, what is it? If you were asked to explain to somebody what that 11,275 million is capturing, without using equations and perpetual growth formula, say, intuitively, what is that big number telling me? What am I trying to capture with that 11,275 million? What is it capturing? So what is a terminal value capture? Yeah.
All the cash flows beyond year 10 for the life of the project.
Right, but make it something that I can relate to. So for instance, let's say I'm not a finance person. I say, I don't understand this cash flow stuff, beyond, it's forever, all of that is too much for me. Just intuitively, what's that 11,275 million capturing?
The value of the park at that time, what you can sell it for?
It is the value that you can sell the park for, lock, stock, barrel, and Mickey included. You see why? Because if you try to extract your characters out of the theme park, say, would you want the infrastructure of the theme park? You're not paying this amount. But if I let my characters stay in the theme park and you buy the theme park, which means that Disney will never, ever sell this theme park, right? So it's a hypothetical, but that is the hypothetical you're answering, is if somebody essentially bought the rights to the cash flows of the theme park and Disney continues to operate the theme park, they'd be willing to pay 11,000. It's the elephant in the room. It's the biggest cash flow by far in this project. And you have to be ready to defend it. You can't just use equations and say, I used R minus G in a perpetual growth model. You have to talk about what this is capturing. And it's capturing the present value of cash flows, but it's also capturing what somebody who buys the business for its cash flows will be willing to pay you in year 10. I need to bring all these cash flows back to the present. And to do that, what do I need? I need a discount rate. And part of the reason I sequenced the class the way I do is because when I was taught corporate finance, I didn't quite understand why it was sequenced the way it was. Because we were taught capital budgeting in the first 4 weeks. Cash flows and discount rates. And discount rates would come from left field and right field and center field, and you had no idea where they were coming from. So where's it going? Why are we using a 10% discount rate? And we were told, just wait, we will get to that in week 5. And to me, talking about investment analysis without a grounding in hurdle rates and discount rates is kind of meaningless. Now we know what discount rate to use on this. It has to be a discount rate that reflects the currency in which we do the cash flows. That's why we use the risk-free rate of 2.75%. It has to reflect the risk of the business this project is in, which is the theme park business, which is why we use the beta for the theme park business, and it has to reflect the risk of the fact that this is a theme park in Brazil, which is the reason we use that expanded risk premium. And the cost of capital we ended up with, based on those assumptions, was an 8.46% cost of capital. We discount the cash flows back, including the terminal value. Today, what we get as the sum of the present values, the net present value of this project, is $3.3 billion. Remember, your role was to be a decision maker? When I showed you the accounting return on capital, it didn't look good. If you trust my numbers, and we'll come back and ask, should you trust my numbers? If you trust my numbers, what does this tell you about the theme park? Good project or bad project? What's the rule for net present value? It has to be greater than 0. So the question I'm asking is 3.3 billion greater than 0? Of course it is, right? But that's just the start of what the net present value tells you. One of the great things about an NPV is when you take a project, as a company, you go out and take a project with a net present value of 3.3 billion, your value increases by 3.3 billion. It's additive. There are very few other measures which have this property. So when you take positive net present value projects, your value increases. If you take a 0 net present value project, what happens? Absolutely nothing. What if you take 100 projects with zero net present value? Absolutely nothing times 100 is still absolutely nothing. If companies basically earn their cost of capital, it doesn't matter how much they grow or how fast they grow, they're not creating value. To create value, you got to earn more than the cost of capital. Yeah?
With the terminal value, does that take into account the maintenance costs?
Yes. So when you do the cash flows in year 10, if you go back, I don't know which page, but if you go back to the page where I had capital maintenance, by the time I get to year 10, I'm actually setting the capital maintenance above the depreciation number, because this project, to go on forever, essentially has to have the same pattern that I've built into the cash flows. Yes?
When do you recognize the increase in values? Is it as soon as they break ground in Brazil?
That's a good question. Did everybody get his question? So let's say Disney says, we're going to build a new theme park in Rio, and people come to a consensus. First, people have to come to a consensus it's a good project. You're saying, when will that show up in my value? You're talking about market value? Okay. You're investors. When will you show that increase in value in your stock price? Will you wait till they break ground in Brazil? Or will you wait till the project is over and then say, oh, that was a good project and increase? That's not the way the world works, right? You know when it'll show up? The minute Disney makes the announcement. And when companies make announcements, markets already form judgments about the future. It's a consensus judgment. There's no one person there, guru working out the cash flow and saying the value of this project. So there's a consensus view. And that's why market reactions to announcements are so useful, because at least they give you the first impressions of, hey, does the market think this is a good idea? So if you take a positive net present value project, your value goes up. 0 net present value, it does nothing. What happens if you take a negative net present value project, or at least a project people perceive to be negative net present value? Your value goes down, right? What if I take a project with a negative net present value of minus 3 billion? You think, who would be stupid enough to do that? I'll tell you, every year, there are at least a couple of hundred net present value projects with the net present value is minus 2 billion, minus 3 billion, minus 15 billion. What kind of projects are these that have negative net present value? How do you end up taking a project with a net present value of minus 15 billion? I'll give you a clue. Remember Eastman Kodak, the company we talked about in session 2? Their value dropped by $2.2 billion in one day, right? What's the project they took that destroyed their value? They bought a company, Sterling Drugs, they overpaid. When you overpay on an acquisition, guess what? You've taken a gigantic negative net present value project. You can wipe out 25 years of really careful project selection in one day. And that's why it constantly amazes me that companies will spend days looking at these $50 million projects, doing what-if analyses and scenario analyses before they take a $50 million project. You come to them with a $5 billion acquisition, all the rules fly out of the window. They say, let's do the acquisition first, worry about value afterwards. If you're going to spend 3 days on a $50 million project, you should be spending 100 times that on a $5 billion acquisition. But the reason is Most companies, if you ask them about an acquisition, don't even think of it as a project. They think of, oh, that's different. We have projects and we have acquisitions. An acquisition is just a gigantic project. And if you overpay, the announcement that you're going to acquire somebody is going to be enough, right? You're going to see the stock price drop. And what do we say? 55% of all acquisitions, the acquiring company's stock price drops on the announcement of the acquisition. For better or worse, markets are looking and saying, this isn't going to work for me. It might work for you as the management, but it's not going to work for me. It's my money that's being spent, and I have to adjust the value today. So the next big deal that you see announced in the journal, forget about the target company. Go look at the acquiring company, because at least you're going to start to get a sense of what the market thinks about this deal in terms of net present value. So everybody comfortable with net present value? So it's basically getting the cash flows, discounting it back to today, comparing to zero. A lot of people, yes, go ahead.
How often over the course of the lifetime of a project do you redo the NPV?
I'm going to come back to that, because that's actually a great question. We think of this, companies spend an incredible amount of time deciding whether to invest, right? And then you take this project and the cash flows actually start to come in. In some of your projects, your cash flows come in close to expected. You're saying this is good. In some of your projects, they come in above expected. You're saying this is great. And in some of your projects, they start to come in less than expected. You're saying, so what? You can think of existing projects as projects where you get a chance to decide. Decide what? Whether to continue with the project, whether to shut it down, or whether to sell it off to somebody. So that'll mean that at frequent intervals, you've got to revisit at least your big projects and ask. And so we'll talk about the techniques you got to bring in. It's very similar to what we do here, but that sunk cost issue we talked about is going to rear its ugly head. Because people are going to say, we've already spent so much money, we can't get out of this. So we'll talk about both the behavioral and the financial implications of revisiting old projects. A lot of people, and this includes a lot of sophisticated finance people, don't like net present values. In fact, if you worked at a private equity fund or a VC fund, they don't want to talk about discounted cash flow values. Why? Because and this is actually human nature. When I ask you how much did you make on your portfolio last year, assuming you had a portfolio, nobody says I made 83,000. You give me a rate of return, right? I made 15%, 18%. For better or worse in finance, when we think about returns, we prefer to think in percent terms, and the net present value is a dollar value. So think of the IRR as the fix to that problem. Where in the IRR, here's what you're doing. You're taking that discount rate that makes your net present value zero. If you think about how you compute IRR for a project or a company or a set of cash flows, most of us at this point in time use the IRR function in Excel, right? And that's like a mysterious function. You say, equal IRR, and you set the cash flows, and it comes back with a number. I've never trusted that number. I have no idea what that number is, and you're going to see very quickly why that number should not be trusted when you get a single number. So here's what I prefer to do. I have the cash flows. What's the IRR? It's that discount rate that makes my net present value zero, right? So I start with the discount rate of 0%, then 1%. So I keep computing the net present value at different discount rates to look to see where the net present value crosses zero. This is called an NPV profile. It sounds fancy, but basically it shows you what happens to your net present value as your discount rate changes. Here's the first piece of news you get out of this graph. The IRR for this project, the point at which it crosses the x-axis, is 12.6%. Is that good? What do I compare it to? My cost of capital for this project was 8.46%. 12.6% is higher than 8.46%, and most of the time, when your NPV is positive, your IRR is going to be greater than the cost of capital. You're saying, what do you mean most of the time? We'll talk about exceptions where the two can give you different rules, but most of the time you do one, you got the other nailed down as well. Just a different way of framing the same answer. Here's the second thing you can learn from this graph. In fixed income foundations, do you talk about duration? I know you did, so act like you did, right? What does duration measure? There are two ways you can actually define duration to somebody who's a complete novice. The first way is a weighted average of when the cash flows from the bond come in. So a 10-year bond, because the cash flows are back-ended, the big cash flows at the end, has a duration of about 8 years. So one way to think about duration is in terms of, hey, on a weighted average basis, when do my cash flows on this project, on this bond come in? The other way to think about duration is it measures how your bond price changes as interest rates change. For any so a high duration bond, small changes in interest rate translate into big changes in the bond price. So a 30-year zero coupon bond is much more sensitive to interest rate changes than a 10-year coupon bond. You think, what's this got to do with projects? Duration measures how the value of your bond changes as interest rates change. This graph actually tells you how the net present value of your project changes. So think of this very loosely speaking as a measure of the risk in your project to discount rates changing. Can discount rates change over the life of your project? Let's look at the pieces. Can risk-free rates change over time? Absolutely. Risk premiums can change. Even betas can change over time. Businesses can go from less risky to more risky. So your discount rate could be wrong, right? So one of the things you always worry about in a project is how wrong could I be? And this graph actually gives you a sense of how much you should worry about that. Because if you have two projects, let's say they have the same net present value of 3.3 billion, and you draw both net present value profiles in the same graph, the riskier project will have a steeper slope to it, right? It'll have the same crossing point. Let's say they have the same IRR of 12.6%, but you might say, I'm going to take the project that's less sensitive to my discount rates because in a sense it's less risky. So that's the other advantage you get with the net present value profile that you would not have been able to get if you'd stayed with one IRR from the number. Yes?
Is the difference between your IRR and your cost of capital, is that meaningful in any way?
It is meaningful. You could actually take that difference and mathematically work into the net present value. That's what EVA tries to do. EVA is this measure of take the percentage return, multiply by the capital invested. You can actually convert the IRR back into an NPV. They're connected mathematically. It's just really messy to do it, but the two are connected through the amount of capital you've invested in the project. So the two are related, but the extent of the relationship will vary depending on how big or small the project is and how much you invested up front. So it'll depend on your cash flow distribution. But the one thing is, one is greater than zero, the other should be greater than the cost of capital. So the IRR tells you that this project is a good project because it's higher than the cost of capital. Here are the two things that said NPV and IRR come from the roots of both approaches are the same, right? They're both time weighted, they're both incremental cash flow based, but here's where there are differences, and we'll come back and talk more about these differences. A project can have only one NPV. NPVs are unique. What does it even mean? What does it say the IRR was? That discount rate that makes your net present value. There are some projects where you can have more than one internal rate of return. In fact, I'll give you a clue as to when that's going to happen. See this graph? When you have two internal rates of return, what has to happen in this graph? It'll come back and cross the axis, and for the certain type of cash flows, you'll actually see that happening. And already you can see the problems with the IRR if you have more than one IRR. You're saying, which one does Excel report to me? That's why I'd be wary. Excel has this mind of its own, and it says, what does this guy want to see? It goes between the two numbers. He'd be happier with this number, I'll deliver it to him. I have no idea which one comes out if you have more than one IRR. Second, the NPV is a measure of dollar value. It's an excess return, but it's in dollar value. The IRR gives you a percentage spread. The two are related, but for some people, the percentage spread is more useful. And thirdly, and this is something we're going to come back to, the NPV makes assumptions about intermediate cash flows that are different than the IRR. For the moment, I'm just going to leave it at that, and that can cause the two approaches to kind of diverge, especially when you're comparing across projects. We'll come back and talk about all three. But I want to revisit the Disney theme park now. When I gave you the numbers for the theme park, I also told you I was going to cheat. Cheat in what sense? I was giving you the cash flows in US dollars, even though the cash flows were all going to be in nominal reais, right? So I have a very simple fundamental question. Based on the cash flows and the discount rate, I told you the project was a good project, right? But the cash flows and discount rate were in US dollars. Let's say I'd done everything in nominal reais. Would I get a different answer for this project. Let me ask you two questions. Would you want to see a different answer if I switch currencies? What's the problem you're going to face if you get different answers using different currencies? Let's say I'm your boss and you're the analyst. I ask you, is this a good project? Here's how you'd have to describe what you found. When I did things in dollar terms, it looked like a good project. When I switched cash flows to pesos, it looked like a bad project. When I switched back to euros, it looked like a good project. And after the fourth currency that you pick, I'm saying, all your analyses are crap, just get out of here. A project can't go from being a good project to a bad project just because you switch currencies. I mean, I'll use the temperature example again. If it's 108 degrees Fahrenheit, is it a really hot day? It's kind of course it is. If I told you it's 40 degrees centigrade, do you feel much better? You shouldn't. It's exactly the same temperature. I can't make a hot day into a cold day by telling you the temperature in Celsius. That's exactly what currency is going to do. And I'm going to kind of take this project and do everything in reais, and you're going to see this play out. So before I show you my numbers, let me take the two pieces of the puzzle. You got cash flows, and you got a discount rate. Right now I've done both in US dollars. My US dollar cost of capital is 8.46%. If I do this entire analysis in reais, my cost of capital has to be restated in nominal reais. So here's the easy part of the question. Will I end up with a higher cost of capital or a lower cost of capital if I do it in reais? Higher, and why? Not because Brazil is a riskier country. Because this is risky anyway, whether I do it in dollars. It's because of differences in inflation. And in fact, that's all I did is I converted my real dollar cost of capital, a dollar cost of capital into a real cost of capital. And when I do my cash flows, that are dollar cash flows, I have to convert them into reais. To do that, what do I need? I need expected exchange rates in the future. And what drives expected exchange rates? In my world, what drives differences in rates across time is differences in inflation. If you have a high inflation currency and a low inflation currency, I would expect the high inflation currency to depreciate over time. It's called purchasing power parity. It's one of the first things you're taught in any exchange rate class. So I'm going to use purchasing power parity to get the cash flows, and I'm going to adjust the discount rate for differential inflation. Let's see if it makes a difference. Let's start with the cash. So the basic rule is you cannot take the dollar cash flows and just adjust the cost of capital, because that will be mismatching cash flows. I have to make sure that both my cash flows and my discount rate are adjusted for the new currency. So let me start with the easier half of the equation. My cost of capital in dollar terms was 8.46%. That was what I computed using a risk-free rate in US dollars, everything in US dollars. The inflation rate, let's say in reais, is 9%, and the inflation rate in US dollars is 2%. This is an adjustment we've been using repeatedly through. Again, if you're in a hurry, you can just add the 7% difference. I'm just going to do it right, which means I allow for the compounding effect. My 8.46% dollar cost of capital becomes a 15.91% real cost of capital. And again, be very clear. If somebody asks you, why do you have a higher cost of capital in real? Your answer should never be because Brazil is a risky country. Because it was a risky country when you did it in dollars. You can't make that go away. It is because of the difference in inflation. 15.91% cost of capital. To get my expected exchange rates, here's what I do. I take the exchange rate today, and I allow for the fact that the real has a higher inflation rate than the dollar. So basically, each year, I allow for that 7% depreciation in the dollar. And it builds over time, because it's 7% in year one, 7% on top of the year. So each year, you're going to see the real depreciate. So here's what the numbers look like. There are my cash flows in US dollars that I showed you earlier. There's my expected exchange rate. And remember, when I did this in November of 2013, the real to dollar exchange rate was 2.35 reais to a dollar. In fact, I showed this in Brazil that year, and they laughed. They said, you're telling us there'll be 4.56 reais to a dollar? That hasn't happened in a long time. We're on the pathway to being a developed market. We're going to be 2 reais to a dollar sooner rather than later. This has nothing to do with whether you're a developed or an emerging market. This has everything to do with inflation. And of course, the real did, after a long period where it strengthened for a decade, it started to zoom back. It doubled over the next period in terms of, I think it went up to 4 reais per share before it dropped back. So what you see there are my predicted exchange rates for the next 10 years using the 9 and 2% inflation rate. You also see the cash flows in reais with that expected exchange rate. And I discount those it says but, it should really be dollar real cash flows. I discount them back at a real cost of capital. What I get as my net present value is 7,745 million reais in today's terms. Since they're in today's terms, I can divide by today's exchange rate, and guess what I get? I get exactly the same net present value that I got if I'd done everything in US dollar terms. To me, this is incredibly good news, and here's why. What does it tell you? When you have to do a project, pick a currency and just do it right. I'd much rather that you did that than pick 5 currencies and do them all wrong, because that's like the clocks that used to be in the entrance to Payback. Are they still there? It says New York, Tokyo, London. They're all wrong. Right? So why are you giving me 4 wrong times? Just give me New York time correctly. I am capable of adding 7, subtracting 5, getting to any other number. But that's the same thing here. If you pick a currency and you do it right, it should just travel across currencies as long as you preserve those consistency rules. You can also see why currencies start to matter when people do valuations. It's because they're sloppy. I've seen people, and this is part of the problem for this is the way we get cash flows. I'll give you a simple example, especially in the context of acquisitions. I was looking over a DCF of a valuation of an Indian company by a US company. And they had projected cash flows in dollars because they were comfortable in dollars. They did a cost of capital in dollars. So I asked them, how did you get the cash flows in dollars? They said, we took the existing rupee cash flow, we converted to dollars, then we asked the management of the Indian company what their expected growth rate would be in earnings, and we plugged that in. What's the question they should have followed up after they asked the expected growth rate? What currency are you projecting the growth in? The Indian company, they were not lying. In fact, nobody here was lying. It wasn't some gigantic conspiracy. The Indian management asked about growth rate, gave what they looked at as growth, and said, we're growing 18% a year in rupee terms. You put in that 18% growth rate on today's earnings and project it out, you've effectively projected rupee cash flows, and you've discounted them at a dollar cost of capital. This is a recipe for overpaying. But you can already see, as if you separate the cash flow, if you're not explicit about currencies, this can happen so easily. So always push when you see cash flows and discount rates to make sure you're being internally consistent. Any questions on currency? Now, if you think back to the Disney theme park, I made a lot of assumptions, right? Where did I get my revenues? I looked at Euro Disney, Tokyo Disney, and I projected out revenues based on that. I could be wrong. When I looked at expenses, I made assumptions that in the theme park, my expense would be 60% of revenues, and I could be wrong. I assumed a 36% tax rate, and I could be wrong. My entire cost of capital is built on estimates, right? Risk-free rate, beta, risk premium, and I could be wrong. This is getting old. I could be wrong on pretty much every number in this project. And I'm not the only one. If any of you have to work in business, which is, I guess, why you're here, and you have to make projections for the future, you will be wrong. And you know you're going to be wrong, and that should make you uncomfortable. If it doesn't, you're probably psychopathic or sociopathic or something, and that might be a quality to have when you're running a business. You're completely immune from it. But uncertainty is natural, and the discomfort that comes with uncertainty is also natural. So I want to put you in your own shoes. You're looking at an analysis you've just done, a valuation, a projection, a business plan, and you look at all the numbers you put out so neatly on a spreadsheet. And you say, I could be wrong on that one. I could be wrong on that one. I could be wrong on that one. So here's my next question. You're faced with uncertainty on all your numbers, right? Which of the following is the path you're going to pick now? Now that you've worked through the numbers, you come up with an expected value. Will you wait for the uncertainty to resolve itself? And if you do wait for the uncertainty to resolve itself, how long will you be waiting? For the rest of eternity, right? Because one uncertainty might resolve itself, but another one takes its place. The reason I bring this up, it's amazing how often companies put off big decisions because they see big uncertainty coming up. So just after the US election's over, then we'll invest. So the election's over, and after the new tax law gets passed, then we'll invest. Guess what? After that gets passed, there'll be another uncertainty and another one. You can never wait for uncertainty to go away, because it's not going to go away. Maybe you're one of those people who just says, look, if I'm uncertain, I will not take an investment. In which case, what will you be doing in your company? Just holding a lot of cash. This is what's happening at Japanese companies. As I said, a typical Japanese company now is 30% cash, 70% business, and that 30% keeps rising every year. It's only a matter of time before Japanese companies are like money market funds. Because if you can't handle uncertainty, you're going to just pile up the cash. You could always do what companies like to do in scenarios like this, which is call in a consultant. Or ask a banker. This way, it's not that the uncertainty goes away. This way, you're covered in terms of making a mistake. It's McKinsey made me do it. Goldman Sachs told me it was an okay deal. You outsource at least the discomfort. You say, it's not my problem anymore. You pay a hefty price for doing it, but you can see why the demand for consultants and bankers is directly proportional to how much discomfort you feel when you have to make a decision. And this is good because we live in a world where uncertainty keeps increasing. You have to keep outsourcing this, so if you're going into consulting or banking, celebrate. More uncertainty, better for you. You could just ignore it. As I said, if that part of your brain is not there, and they've taken pictures of psychopaths and sociopath brains. There's a part of the brain that's actually missing. It's actually the same part that great gamblers have missing and great traders have missing. Think about it. Great traders, sociopaths, and great gamblers share brain cells. Of course, they've taken it out in different ways because, and here's the reason, it's a part of the brain that makes you human, right? That makes you worry about uncertainty. You lack that. You think like a robot. It's all about the cash flows. I've done the expected cash flows. What's the big deal? I can't do any of the top four. So I try to figure out ways where I can cope with uncertainty. So I'll take you through some of the coping mechanisms, at least with this project. Here's the oldest one. One of the things that worries me about this project is it's a big project, right? It's $5 billion. So what if I could at least give you partial salvation and say, hey, you will make the $5 billion back in 7 years. So what I do is I add the cash flows up to see when I get my initial, it's called payback. It's as old as time. There are some companies that actually base decisions on payback, and your rationale is once I make my initial investment back, everything else is icing on the cake. So let's just figure out how many years it'll take me to get my money back. And you want this number to be a high number or a low number? You want to get your money back as quickly as possible, so low payback is better than high payback. Most companies that use payback use it more as a constraint than an objective. You know what I mean by a constraint? They'll say, take any positive net present value project as long as the payback is less than 5 years, so 7 years, because it kind of acts as a risk check. So that's the first. It's been around a long time. Here's the second. You can ask what-if questions, right? What if this? What if that? And let's face it, it's so easy to ask what-if questions now. As opposed to when? As opposed to 35 years ago. 1980, the summer of 1980 was the middle of my MBA program. I was at UCLA, first year ends. I go looking for a summer job. In 1980, the world was in shambles. The economy was completely dead in the water. And getting summer jobs was almost impossible. I ended up landing up a job at an outfit called Watermark, which is a small company that produced one syndicated radio show. You know what a syndicated radio show is? You make a radio show and you sell it to stations. And every week they pay you for the show. In fact, some of you might have heard of the show. It's called American Top 40. Okay? If any of you have driven across the US on a Sunday, it's an incredibly creative show. And here's what it does. It starts with number 40 that week, and then it counts down to number 1. And between each song, there's a pitter-patter of the person doing the show coming and acting all informed. Don't fall for it, because they've been read all the scripts, so they act like they know the person who sang the song and what that person went through last week. No. But it takes about 4 hours. And stations were paying $1,000 a week, and they were selling American Top 40 to 520 stations every week. So that was their basic product, 520. So they're a pretty profitable company. But they wanted to introduce a second show. This is where I came in. My job, at least the way they described it, was to come in and tell them whether the second show made sense. The second show was going to be called Soundtrack of the 60s. And here's what they were going to do. Remember, this is 1980. They're going to go back to the same week in 1960, and guess what they were going to do? Count down the top 40 songs. It's an amazing shift in creative thinking. But this was for this shows you, for the oldies in the group, right? They weren't getting enough old people. So they would go back to the 60s and get those people. So my job, at least in theory, was to come in and do a capital budgeting. And this is after my very first corporate finance class. I come in full of illusions, totally naive. And I remember the first day I walk in, it's a small office, right? It's a small business with cubicles. Nobody had an actual office. I had a mini cubicle. I couldn't even fit in it. Right? I came in and I remember I walked to the CFO's cubicle. The CFO had a cubicle, and I said, what are the cash flows? Because every problem I'd ever seen in capital budgeting came with cash flows. So when they said you had to analyze the project, I expected them to hand the cash flows and a discount rate, and I'd plug and chug and say this is a good. They said, what cash flows? And the guy hands me a ledger sheet. Have you guys even seen ledger sheets? Ledger sheets are just a blank sheet of paper with lines already drawn in for the columns. And that was actually a good thing, because otherwise you actually had to take these pieces of paper and sit there with a ruler drawing lines. This could take up half your project. So they gave me the sheets with the lines already drawn and nothing on them. I said, what am I going to do with this? They said, fill it in. That's why we hired you. So to get the revenues on this new show, what do I need to estimate? How many stations they can sell the show to and how much they would charge. So I went to the marketing guy's cubicle, and the guy hated me at first sight. I was a numbers person. He was a creative person. You know how creative people think about numbers? They think you're basically the return of the plague. So the guy acted like I wasn't even there. He kept walking past me as if I wasn't there. And after about 3 days of being completely ignored, I said, you know what, I need to get started. How many stations do you think you can sell the show to? He looks past me. He said, I don't know, 200, 300, 400, something like that. And he walks into his cubicle. I know this is all I'm going to get from this guy. So I run back to my mini cubicle and I start my ledger sheet off. And guess what I used as my base case number of stations? He said 200, 300, 400. I did the logical thing. I went right down the middle because I said that must be his base number. So the ledger sheet gets started, 300 stations. Every single line item was like pulling teeth. I'd ask somebody about, now what will you sell these shows for? What will it cost? But by the time I got to about 4 or 5 weeks into my internship, I had the ledger sheet filled. Cash flows. I don't even know how I came up with the discount rate. I came up with the discount rate. I discounted the cash flows. I came up with the negative net present value. I'm almost doing a dance in my mini cubicle saying, this is amazing. And I go to the CEO and said, I've done the analysis. I'd like to present it to you. He said, come back tomorrow. We'll have 3 directors here. And they're all sitting around a table sharing 1 cup of coffee. He said, okay, present your numbers. So I present the numbers. And I hit them with the climactic finding. This project, based on its cash flows, is a bad project. You shouldn't be taking it. They look at each other and they say, what would happen if you tried 400 stations? My stomach drops. Remember, this isn't an Excel spreadsheet where I change 300 to 400. This is a ledger sheet filled out by hand with calculator. Changing 300 to 400 is basically starting from the beginning and doing every single number. And I said, why would you want me to do that? They said, we've already decided to take the show. We just want you to confirm it for us. I said, you hired me to do something you've already decided to do? At that time, I thought it was because they were a small outfit, they were not very. This is more the rule than the exception. In most companies, the decision gets made on what to do, then the number crunching begins to justify a decision that's already, it's not the way it's supposed to be, but it is the way it is. But in 1980, asking a what-if question was really, really, really difficult to do because answering it required redoing all of the numbers. And that was a good thing because it put a natural constraint on how many what-if questions you could ask. Today, with Excel, you could write macros to do what-ifs for you. It's so easy. In fact, it's become far too easy. I think 90% of the time that many people spend in valuation and capital budgeting is asking what-if questions. What if this, what if that, what if this and that? This project you're going to turn in is the 20-something iteration of this case, of various cases I've given this class. And I'm going to make the same plea to you that I've done for every other class. There are going to be about 90 groups turning in a case report a week from now. Please make it brief, because I have to read your reports. Don't make yourself Charles Dickens. I mean, this isn't a novel that you're writing. There are no points for creative thought processes here, right? Or creative writing. Create thought processes and the numbers I'm okay with. So every semester that I've given this case, I've made that plea. And most of the time people listen. But I remember about 4 or 5 years ago, in one of these cases, I get back at 90 reports, and I stack them up. 89 of them have followed the instructions loosely, at least 8, 10, 12 pages at the most. And there's this one report that sticks out. It's 110 pages. So what did these guys do? So I pick it up. They've run 105 different scenarios. Scenarios like, what if Janet Yellen catches a cold? Let's work through the net present value. Looks bad. But at the end of the process, here's what they found. In 55 of the 105 scenarios, the net present value was positive. In 50, it was negative. And here's how they concluded. Because the end game for you is, would you take the project? And here was their final decision. They said, if you know you're going to be in a good scenario, take the project. If you think you're going to be in a bad scenario, don't take the project. We're too confused, you make the decision. And guess what? They were being honest. That's what a lot of what-if analyses ends up doing, is rather than leading you to converge on a decision, it actually leads you to diverge. So at 8 o'clock at night, you think you're done with the case, and some stupid person in your group says, let's do some what-if analyses. At 1 a.m., you're saying, oh my God, we're more confused than we were 5 hours ago. That's not the way it's supposed to be. So here are my recommendations if you ask what-if questions on this case or on any other kind of analysis. First, keep it focused. Less is more. Pick 1 or 2 things that you want to ask what-if questions on. Don't ask what-if on every single input that you have. Second, remember what the end game here is. You want to make a better decision, not churn out page after page after page after page of tables. So you have to think about, if I do what-if analyses, how do I marshal what I find and present it in a way that a decision maker can converge on a better decision? And I have a reading recommendation I will have for you, since you have so much free time in your hands with so little to do in this class. It's a book called The Visual Display of Quantitative Information. It's written by a guy called Edward Tufte, T-U-F-T-E. Just type in T-U-F-T in Amazon, you'll find the book. It's a $15 book, I think. It's a book about how to present information. And in fact, it's a skill that's almost completely lost, because insert chart in Excel is so close to you, right? So you feel like inserting a chart, insert a chart, insert a chart. You have 2 numbers, insert a chart. I don't need a chart to show you 2 numbers. But it's so easy. You can make the chart 3-dimensional, but it's still 2 numbers. So in that book is my favorite graph of all time. It's actually a graph that Tufte reproduced, that somebody drew by hand 150 years ago, or 200 years ago. And in this graph, the person who drew the graph told the story of Napoleon's ill-fated attempt to invade Russia in the 1800s. I don't know what it is about Russia that attracts European monarchs, but it's big, it's out there, you want to invade it. So one day Napoleon wakes up and he says, I want to invade Russia. So he gets his big army going. So see the width of that line? That's Napoleon and the army leaving Paris. Napoleon on a horse and everybody else walking behind him. And so they're marching through Europe. You're saying, what are these little tangents? That's when they get distracted and they invade Poland because it's on the way, and they keep going. And notice the army is getting slightly smaller. Right? It's Russia, and Russia is a big country. They're getting to Moscow, but Moscow is a long way away. So they keep marching and marching and marching, and they get to the outskirts of Moscow, right there. It says M-O-S-C-O-U. So on around December 12th, or whatever year that was. Have you ever been in Moscow around in December? Don't go there. It's really, really, really cold. And that's what Napoleon said. It's really, really, really cold. I want to go home. So there's the army starting its march back. So now the black is the retreat of the, and there's the temperature on the axis as they're going back. So look at the army. By the time you end up back in Paris, it's 3 guys carrying Napoleon on their shoulders. The entire army is gone. This is a great graph. All you have to show me is what will happen to the net present value of your project as your margin changes. This guy had to show what happens in an army as the temperature changes, and geography in there and history in there. But this is a creative graph because it tells the story in a graph. Here's something to remember. No human mind can deal with 100 numbers on a page. If the way you present your what ifs is table 1, table 2, table 3, table 4, table 5, you might as well not do it because nobody's looking at those numbers, including me. So if you want to do what if analyses and it is changing your decision, you want to take what you find in your what if analysis and present it and say, this is why it changed, and this is the picture of how it played out in our decision process. This is going to be a big business going forward of presenting data. There's actually a company called Tableau. I don't know whether you've seen it. Basically, they will take information that you have as a company and they'll charge you through the nose for doing it. But you can see why the demand for it is picking up, because otherwise you're just inundated with numbers. And you want to figure out a way in which you can make better decisions. So that's the second way, is ask what if questions, but keep it kind of focused. This is the third way. And this is something you could not have done 30 years ago. Have you ever heard of Monte Carlo simulations? You might have heard about it in a statistics class, and you said, who cares, and I never got to use it. And 30 years ago, you'd have been right. To run a Monte Carlo simulation, you'd have needed a mainframe computer and tens of thousands of dollars. In a Monte Carlo simulation, here's what you do. Remember in the Disney theme park, I had to project out revenues and expenses, and I gave you point estimates. You know what point estimates are? I gave you my expected value. I said, expenses are probably going to be 60% of revenues. Revenues are going to be, X million dollars. But in my mind, I'm screaming, saying, but that's my expected value. What I have is a distribution. I'm uncertain about that number. In a Monte Carlo simulation, you take each input, and rather than give me a single number, you give me a distribution. So let me apply this to the Disney theme park. I gave you my expected revenues, right, based on what I saw at Euro Disney and Tokyo Disney. But even across those theme parks, some did a little better, some did a little worse. So what I did is my first input was I gave a revenue number, and I said the actual revenue numbers can range from 20% below to 20% above my estimates with equal probability of it happening. This is called a uniform distribution. Basically, it means you're completely diffuse about what you think can happen, but you have an outer end on each, the worst case, best case, so you've got a distribution. For the expenses, remember I used 60% of revenues as my point estimate. In the simulation, I gave a distribution. This is called a triangular distribution. My expected value is still 60%, but it could be as low as 45% of costs in Rio turn out to be much lower than expected, or as high as 75%. And finally, I'm worried about country risk. I used a 3% country risk premium, but November 2013 was in a sense a high water mark for Brazil. Things looked really good, but Brazil, things can change pretty dramatically. So let's say the country risk premium could be as high as 6, or maybe Brazil can make it to becoming a developed market, it could be as low as 0, and that I used a normal distribution. So now instead of 3-point estimates of the distribution, you say, what do you do in a simulation? In a simulation, you go pick a number out of the revenue distribution. It could be higher than your base or lower than your base. Then you pick a number out of the expense distribution. It could be much higher than 60 or much lower than 60. You pick a number out of the country risk premium distribution, much higher than 3 or much lower than 3. And I value I come up with the net present value. And I do this again and again and again. In fact, the way I would start simulations, the professor came in with 3 bowls filled with the little sheets of paper with numbers written on them, and actually physically picked one out of each bowl, computed the value. The whole class was just picking out of bowls. Thank God we don't have to do that anymore. Because if you have a program called Crystal Ball, it's an add-on to Excel. They used to have it here. I don't know whether they still have it at NYU. If they still have it here, here's all you have to do. Go in, open your Excel spreadsheet that you worked on your computer with Crystal Ball, and you can actually take your base case inputs, the numbers that are fixed, and replace them with distributions. Crystal Ball's default is it runs 100,000 simulations. Each time it runs a simulation, it comes up with a different net present value. And it presents a net present value not as a single number, but as a distribution of values. I'll give you the bad news first. The median for this distribution across all of the simulations is about 3.3 billion. Why is that bad news? Because that's what I got in my base case. But I shouldn't be surprised. My expected values were matched up. But here's the new information you're getting. When you take a project, one of the things you worry about is, what if I've made a mistake? What if this is a bad project? Can I answer that question using this distribution? What's my definition of a bad project? Your net present value is less than 0. So I can actually count the outcomes less than 0 and say, you know what, there's a 9% chance you could be wrong. Now, how do you use that? Depends on how risk averse you are. You might say, look, I will not accept projects if that's more than 5%. I'm going to leave that decision to you because you're the decision maker. Remember how we sometimes do best case and worst case analyses? They're in the distribution too. Your best case for the project is that its net present value is close to 9 billion. The worst case is your net present value is minus a billion. Everything we talk about in the context of what if analyses is in here, and it's much richer because you get an entire distribution. In fact, I know people do scenario analysis. Scenario analysis, you just pick 4 scenarios. A simulation does the whole thing. And this is now doable as long as you're willing to make an investment. In what? The easy part is invest in Crystal Ball, which I would suggest you buy while you're still a student. I think it's $100 when you're a student. It becomes like $600. You can download a free version, and I'll send you the links to it from Oracle and try it out. It's the nice thing about Crystal Ball, the learning curve is almost nothing. You can get it and you're off and running. But your real investment has to be is when it asks you for what kind of distribution. It offers you 53 different distributions. And let's face it, and I might be talking for myself, when I came out of my statistics class, there's only one distribution that stuck in my mind. Normal distribution. Why? I'm normal distribution, so let me go with that, right? Let's face it, that's the only distribution you tend to remember 2 weeks after statistics class. So guess what happens when people use Crystal Ball? Everything gets normally distributed. Fight that urge, because not everything is normally distributed, which means you've got to kind of review things like a log normal, a binomial. You're saying, what the hell is that? I actually have a very short paper matching distributions to whatever. So if you're modeling interest rates, this is what will work for you. So I'll send that link as well. If you want to put the time in, it's well worth the effort because the tool is at your fingertips. And this is a great tool to have when you face uncertainty. Any questions on simulations? So at the end of this process, you have a distribution. You've come up with a net present value, and I tell you there's a 10% chance your net present value could be negative. So the onus is back on you. I've given you both the net present value and the 10% chance. And you have 3 choices. One is you can say, we'll take the information, just see it as information and still take the project. Or you might say, I'm taking the information, but because that 10% looks high to me, I'm going to reject the project. I think there's a danger in doing that. You know what that danger is? You worry about risk, right? And that's natural. But when you did your net present value, what did you use as your discount rate? A risk-adjusted discount rate, and you punished the project already for being a risky project. And what are you doing now? You're punishing it again for being a risky project. There's a grave danger of, and this is the downside of simulations, is people sometimes use the simulation for purposes of risk correction when in fact it's really for a different purpose. More for information, so you know what the project looks like, than to actually change your decision. So if you find yourself constantly changing your decisions after you've done a simulation, you might be misreading what simulations are for. So keep that in mind as you look at any kind of simulation outcome. It's not supposed to be there for risk adjustment, it's really more for information. Any questions on the Disney theme park? No. Somebody's phone going off? So now I'm going to shift gears. When I looked at the Disney theme park, I did everything from the perspective of the entire business. What do I mean by that? When I computed returns on investment, I looked at after-tax operating income and total invested capital. When I looked at cash flows, I looked at cash flows before debt payments and discount in the back at the cost of capital. Now I'm going to switch gears and talk about how things are different when you look at everything as an equity investor. When you're an equity investor, when I ask you how much you're investing in a project, your focus is going to be on your portion of the investment, not the entire cost. So I'll give you an example. You're buying a building. It's costing you $1 million. So when I ask you, what does the building cost you? You're going to say $1 billion. That's a perspective of the entire business. Then I ask you a different question. As an equity investor, what are you investing in this building? Your answer is going to be $1 billion net of the debt I took on, because I don't have to come up with that money. I'm investing $150,000. So when you do equity, your investments have to be stated in terms of what you invest in the project. When you look at returns as an equity investor, your returns have to be after you make your debt payments, right? Because you don't get to keep that entire operating income. So when you look at income, it's going to be net income. And when I ask you what kind of returns do you make, you're going to divide the net income by the equity you've invested, which is going to give you a return on equity. When I ask you what your cash flows are, you're going to look at cash flows after interest and principal payments, not before. Your entire focus narrows down on what you are investing in the project and what you get back. And of course, your discount rate now has to become your cost of equity. So I'm going to use a project to illustrate it. I'm sorry I fit so much into this page. Don't read that page. It's going to make you dizzy. So what I'm going to do instead is give you the description of the project I'm going to analyze. It's a new iron ore mine that Vale is going to make in Canada. I'm deliberately kind of moving geographies around, because if you're a global mining company, you're not going to make all your investments in Brazil. The iron ore mine is going to require an initial investment of $1.25 billion, which is going to be depreciated down over 10 years to a $250 million salvage value. You're saying, why don't you let the iron ore mine go on forever, just like you did the theme park? Why wouldn't I? Because once the iron ore is gone, there'll be nothing left. So iron ore mines are not good. So you don't have the option with an iron ore mine saying, why don't I just assume forever after year 10? Because there is no forever. The iron ore comes out of the ground, the mine becomes useless. The mine will start production midway through the next year, 4 million tons of iron ore, and then it'll build up to about 6 million tons in year 2 and 8 million in year 3 before leveling off. And I'm going to make your life simple. I'm going to assume that the price in dollars was $100 when I did this. And I'll give you what the updated price is, and you're going to see very quickly how good projects can become bad projects. $100 price, and it's expected to keep pace with inflation for the life of the plant. So it's $100 this year, and it's going to grow at the inflation rate over time. The variable cost of production is expected to be $45 per ton, with a fixed cost of $125 million. Both costs, again, will grow at the inflation rate over the life of the project. The cost will be in Canadian dollars, but the expected values are all converted into US dollars. And at the time that I did this analysis, it was 1 Canadian dollar to 1 US dollar. Any Canadians here? What's the exchange rate right now? 0.77. So iron ore prices are now down to 40. So we'll come back and talk about 4 years later, what would I do if I took this project? But at that time, it was 1-to-1. The working capital requirements are going to be 20% of total revenues, and you'll have to invest at the start of every year. And I'm going to assume Vale's corporate tax rate of 34% will apply to its income. So I've given you the broad outlines of the project, and here's where I'm going to start to do something different from the Disney theme park. Disney theme park, I never talked about debt and the cost of debt and repaying the debt, because I was looking at everything from the perspective of the entire company. Here, because I'm focused on equity, I'm also going to tell you that upfront of the $1.25 billion they have to invest, Vale is going to borrow $500 million. And I also have to be explicit about what I'm going to do with that debt. I'm going to repay the debt in equal annual amounts. It's called a term loan. Right? I'll give you the classic example of a term loan. If you take a mortgage on your house, your mortgage payments are actually set as a constant through the life of the loan. What changes, though, is the composition of that payment as you go through the loan. So when you make your first mortgage payment, most of it is going to be interest, very little principal. And as you hold the loan, as you get to further and further into the loan, you're going to see the composition. You're saying, who cares? Why do I care how much of if I know what the total payment, it's always going to be, in this case, $61.8 million. Why do I care how much of it is interest and how much is principal repaid? For taxes, right? Because interest is tax deductible, principal repaid is not. Mortgage holders recognize this the painful way, which is when they do their itemized deductions in Schedule B, they realize as their mortgage loan ages, they're getting less and less of a deduction on this. They say, what the hell happened? I'm still paying out the same amount. The composition of the loan is changing as you hold the loan. And you can see the breakdown changing. Initially, its interest expense is 20.25 million, principal repaid is 40. But as you go through, by the time you get to year 10, only a small, tiny portion of the amount is interest expense. Most of it is principal repaid. So I break down the payment, and by the end of the 10th year, of course, the debt is paid off. Now remember, I'm bringing in an equity focus, so this is the portion of my financing that comes from debt, and I've given you the portion of my cash flows that have to go to debt. So let's talk about hurdle rates. I'm doing everything in equity terms, right? So I need a cost of equity. I'm also going to do everything in real terms, not in REI terms, that's very confusing, not in US dollar terms, but in real terms. What does that mean? I'm going to essentially want a cost of equity that's based on a real risk-free rate with no inflation built into it. And you're going to see why this is going to make my life easy, is I have a cost of capital in US dollars of 8.13% and a cost of capital in reais of 15.55%. So those are numbers we computed, and this was on the bottom up. I'm going to try to convert that 8. Did I do everything in real terms or do it in US dollar terms? Maybe I did it in US dollars. Okay, let me take that back. I decided to do everything in US dollar terms. We'll talk about what would be different if you did it in real terms. It would probably be easier to do it in real terms because everything is growing at the inflation rate. So I'm going to do it in US dollar terms, which means my cost of equity is going to stay at the 8.13%. So let's work through the cash flows here. And I want you to think about the contrast. I know it's going to be tough to do with how I came up with cash flows for the Disney theme park. I'm going to start at the same place. I'm going to start with revenues, which is going to be production times price per ton. And you're going to see that build up over time as my mind starts to kick in. Okay? I'm going to subtract out the variable costs, which grow with the revenues. My fixed cost is 125 million, growing at the inflation rate of 2% for the life of the loan, the mine. I subtract out depreciation. I come up with operating income. And again, like the Disney theme park, you see it start with low operating income and build up over time. I now do something I did not do in the Disney theme park. In the Disney theme park, I stopped with operating income, netted out the tax, came up with after-tax operating income. Here I subtract out interest expenses. Remind me again why I need to do that? Because I care about cash flows to equity. Cash flows to equity are after interest expenses. I subtract out the interest expenses. I come up with taxable income. How come, what happens to principal payment? Why isn't it showing up here? Because it's not an expense. It's going to show up in my cash flows, but it's not going to show up in my income statement. It's only the interest portion that's tax deductible. I subtract out taxes, and there's my net income. It starts as a loss and builds up to a profit. Now, if I wanted to do the book value of this investment, I'm going to do exactly what I did for Disney, come up with the CapEx, working capital. But here the difference is, each year, once I get the book value of the total investment, I'm going to subtract out the debt outstanding. I got that in this page, which tells me how much debt is outstanding. So I subtract out the debt outstanding to get the book value of equity on this theme park. So everything is focused on equity. I'm looking at net income. I'm looking at book value of equity. And in fact, if I divide the net income by the book value of equity, I'm going to end up with, when I divided after-tax operating income by invested capital, I ended up with return on invested capital. Dividing net income by book equity gives me what's called return on equity. And the return on equity for this theme park, again, like the Disney theme park, starts negative, builds up to positive. My average return on equity over the 10-year period looks really good. It's about 31%. I would compare it to my cost of equity, to my US dollar cost of equity, and my US dollar cost of equity is 11.13%. Is that right? It's not right, right? Oh yeah, it's 11.13%. I was wrong the first time when I said 8.13%. It's 11.13%. 31% is greater than 11.13%. The project is a good project because the return equity exceeds the cost of equity. So what I'd like you to do when you get a chance is put the Disney theme park analysis and the iron ore project next to each other. Look at the differences in how I computed income, cash flows, and discount rates. And you're going to very quickly see as your perspective changes, the way you measure those things is also going to change. So if I were basing my decision on accounting returns, this project is a slam dunk. A really good project, return on equity, vastly exceeds the cost of equity. Let's talk about cash flows. To get to cash flows, what do I have to do? I have to add back depreciation. I have to subtract out CapEx. I have to subtract out change in working capital. Right? Oh, incidentally, if you want to do what I did with the return on capital and compare to the cost of capital, you could do this for your company with return on equity as well. You can compute the return on equity for your entire company compared to the cost of equity. And if your company is a good company, it should earn more than its cost of equity. When you try this for your company, though, you'll notice that the return equity number is a much shakier number than the return on capital for a very simple reason. Book equity is a much more volatile number than book value of capital. About 1 in 9 companies have negative book values of equity in the US right now. How does your book value of equity become negative? What does a company have to do? It can lose money for a long period. You end up with negative book equity. But there are lots of healthy money-making companies with negative book equity. Like IBM has negative book equity now. You know why? When you buy back stock, how do accountants record that on your balance sheet? They take your book equity and they subtract out what you bought back. And because you're buying back stock at way above book value, if you buy back 20% of your stock, if Apple bought back 20% of their stock, their book equity, you're saying, what does that mean? It basically means don't trust accounting statements. Right? That's basically what it means. It's not that you can, if Apple bought back 20, it's not like you're saying, oh, this is a horrible company, it's going to go bankrupt. It's that the nature of recording book equity will mean it's a more volatile number, which means the return on equity is going to become a more volatile number as well. But the comparison still holds, which is you want to compare the return on equity to the cost of equity. So let me go back to cash flows, right? So to get from net income to cash flows to equity, not from after-tax operating cash flow to the firm, my perspective is different. The first 3 adjustments are going to be exactly the same. I add back depreciation and amortization, I subtract capex, I subtract change in working capital. So everything you said about those items in the context of the theme park will apply here as well. But notice the one extra item that has popped up. Now I have to subtract out principal repayments. Why? Because I'm an equity investor. I get only whatever's left over after I've paid the bank. And when I subtract out principal repayments and incorporate the salvage value, and I'm assuming I can sell it at book value, you know why I do that? Because if I sell at any price other than book value, I'm going to have a tax consequence, right? I don't really want to mess with it. So the salvage value is set equal to the book value. The project ends after 10 years. I discount, these are the cash flows that I'm going to discount as an equity investor. And in companies with lots of debt, this can be a small proportion of what I see as cash flows to the entire business, because it's cash flows after interest expenses and after principal payments. And that is the cash flow I'm going to be discounting back. The discount rate I use for it is the cost of equity, 11.13%. Discounting cash flows to equity at the cost of equity, it's entirely consistent. I get a net present value of $304 million. So tell me again, if it's a good project or bad project? Based on the net present value, it's done entirely on an equity basis, it looks like a good project, a positive net present value project. And if I do the IRR, I get exactly the same conclusion. The IRR for this project is about 28%, well above the cost of equity of 11%. On an IRR basis, looks like it's a good project. Cash flows to equity, discounted the cost. I did everything in dollar terms. Incidentally, if I'd done, and this is where I want to ask the what if I'd done everything in real terms? Lead me through each input into this process and tell me what would happen if I did things in real terms. First, my cost of equity in dollar terms was 11.13%, right? If I did things in real terms, would my cost of equity be lower or higher? You have 50-50 shot, try the other half. It's going to be lower. Why? Because even the US dollar has a 2% inflation rate in it. So if I did things in real terms, roughly speaking, my cost of equity is going to be about 2% lower. Not exactly because of the compounding effect, but I'm going to have a lower cost of equity. You're saying this is good, lower is better, right? But when I do my cash flows now, if I do everything in real terms, what's going to happen? I'm going to have to take out a 2% inflation rate each year. So my cash flows are all going to be lower by 2% compounding over time, and the inflation taken out. I'm going to have lower cash flows and a lower discount rate. And if I do this right, the net present value for this project, if I do everything in real terms, should be exactly the same. And if you don't believe me, I think in the book, I actually have taken out inflation from both, and I've done everything in real terms, I should end up with the same net present value. Yeah.
In real terms, wouldn't you want to say use the PPI for your costs, or
whatever you decide to use as your inflation rate? I'm fine. So the 2% I'm agnostic.
You have to be consistent, I assume.
You want the true inflation rate, right? And the reason I don't want to PPI, CPI, we can go the debate. It's an open question as to which one actually they probably all are imperfect measures of inflation, and here's why. How does the government compute inflation rates? They use a basket of goods and services that they track over time, whether it's a PPI or CPI. And whether we like it or not, even in the US, where they make an unbiased attempt, sometimes they overshoot, sometimes they undershoot. So I'm not clear that a PPI is going to do that much better than a CPI. You want an overall inflation rate in the currency. You want to see what is the measure of true inflation in this currency across everything. Not just to producers, not just to consumers, but across the board. And the PPI and CPI are competing measures of what that inflation rate is.
I guess my question is, if they're diverging, then margins could be changing over time, and you're not picking that.
You're not talking about the PPI, you're talking about inflation in your inputs, which is very different, right? So if you're an airline, what's the inflation rate you worry about? Your biggest cost is oil, right? So in other words, when you do your cost, it's not the overall inflation rate, it's the inflation rate of oil that is driving your cost of goods sold and your margins. So when you do the margins for an airline, you don't worry about so when we talk about inflation corrections here, we're not talking about inflation specific to the company. So we do our cash flows with your assumptions about margins changing over time. So if you think oil prices are going to go up, you're going to build in lower margins, you're going to come up with cash flows in US dollars. I have the cash flows in US dollars, I want to make them real cash flows, and that's why you have to wait till the end to do it. I'm just going to take out the overall inflation rate from those cash flows. So you've captured the oil price effect through your margins and through your cash flows. This is really almost a cosmetic change of taking out the inflation effect from your cash flows. And that's why it cancels out. So I'm not saying inflation is neutral. Don't walk away with that conclusion. Inflation can hurt some companies and help some companies depending on which products are showing the most inflation. This is really about cleaning up your last step in the analysis, and the net present value you end up with should be the same. Now in doing this analysis, if you remember, I used $100 per ton iron ore price, and I used a dollar for dollar Canadian dollar US dollar exchange rate. You're saying, so what? In fact, when I did this in November of 2013, I asked some what if questions. What would the iron ore price have to be for the net present value to be positive? Because that's a big thing I worry about as a commodity company. So the break-even point I ended up with was about $70. Or maybe closer to $80. And in November of 2013, of course, I could have done the break-even. The price was 100. But basically, you can see as the iron ore price drops, which is no surprise, my net present value goes from positive to negative. I also asked the what-if question about exchange rates, because clearly I'm making the dollar for dollar, but my costs are all in Canadian dollars. My revenues are in US dollars. I have a mismatch. And to the extent that the Canadian dollar gets weaker, I actually have a higher net present value. Tell me why again? Because your costs are in Canadian dollars and your revenues are in US dollars. When the Canadian dollar gets weaker, it's like having your cost of goods sold go down, but your revenues stay high. And when the Canadian dollar gets stronger, you actually see your net present values decrease. So let's admit to the obvious. This project is subject to macro risk from iron ore prices and from exchange rates changing. And this is going to be true for a lot of commodity companies. Royal Dutch, yesterday you probably read in the Wall Street Journal about them making huge tens of billions of dollars that they're investing in low cost, in new technologies for getting high cost oil out of the ground. Whether it works or not is going to be a function of the oil price. So here's my question to you as a manager at Vale. The value of the mine is very much a function of iron ore prices. Would you hedge against iron ore prices? Okay? Make the choice, because I'm going to ask you the same question about exchange rates. Would you hedge? I'm going to argue that the two are very different risks, that you should be hedging one and not hedging the other. And I'll give you my rationale. But you're exposed to both risks. And then the third question I ask is, on exchange rates, would your answer be different if you were in Brazil as opposed to Canada? But think about the two kinds of risk, iron ore prices and exchange rates. Hedging versus not hedging. So if you're an iron ore company, would you want to hedge against iron ore prices? It's kind of a generic question. Should a commodity company hedge against commodity price changes? Why do I invest in an Exxon Mobil or a Royal Dutch? Not because I love the management. I don't even know who the management is. It's not because I expect them to take great projects. Indirectly, why am I investing in an oil company? Because I have a point of view on oil prices, and I'm using the oil company as a vehicle to invest in the company. Why do I invest in Vale? It's not because I love the management of Vale, but because I have a point of view on commodity prices and I'm investing in your stock. Do you see why hedging against commodity price risk for a commodity company can undercut why investors invest in the company? Barrick Gold, the entire management got fired precisely for this reason. Because they were hedging gold prices, and as gold prices kept going up, investors kept saying, why aren't our earnings increasing? Until somebody woke up and said, they're hedging everything. If you're an oil company, if you're a gold mining company, if you're a commodity company, you hedge against commodity prices, you're hedging away the main reason I invested in you. With exchange rates, it's a little fuzzier, right? Because there you could actually argue that this is a cost. By knowing what your cost is more precisely, you can be a better miner or a better, in other words, it frees you to focus on what you can do. I can forgive, or I can see why companies might hedge exchange rate risk if they're commodity companies, but hedging commodity price risk seems to undercut the reason I invest in you. So I'm going to close off today with a page that I use when I see a news story about a company hedging. Or if I look at the annual report, I see they're hedging something. The question I ask is, what is the cost of hedging this risk? If you have no cost at all, if you can hedge a risk costlessly, you think, how would that happen? If you're a retail firm, how do you hedge location risk? You know what I mean by location risk? You open a new store. The highway next to the store might get shut down and the store might not do well. That's location risk. How do retail companies hedge location risk? They have lots of stores, right? Some of their stores do better than expected, some do worse than expected. That's natural hedging, it's costless. Of course you should do it. If it costs you to hedge risk, the question I'm going to ask you is there a significant benefit you can point to? It can take the form of higher cash flows in some cases, a lower discount rate in other cases, or if you're a very highly levered oil company, I can see why you might want to hedge some of your oil price risk so that you don't go bankrupt. So if there's a benefit, then I'm willing to cut you some slack, but then I'm going to ask you a final question. Could your investors have hedged this risk more cheaply than you do? What's the question I'm asking Disney? If they come to me and say, should I hedge exchange rate risk? I'm going to ask them, is it cheaper for you to hedge the risk? Or remember BlackRock was their largest institutional investor. Do you think BlackRock can hedge the risk cheaper than Disney can? Yes, and here's why. They have hundreds of stocks. They just have to hedge the collective risk, which is going to be a lot less. So all I'm saying, and this is the last thing I will say for today, is companies, I think, hedge a lot of risk that they have no business hedging, that they should be passing through. So on Monday when we start off, we're going to complete much of the rest of investment analysis, but keep working on your case. So I'd like to see some questions come up about the case, and when you face a question, make your best judgment and move on.
Countries are very dependent on commodities like oil, in this case, there'd be a natural hedge where if commodity prices move, exchange rate moves, then we're not sure.
Exchange rate needs a huge amount to offset the money. If oil prices go to how much do we get? It's true. But there's a partial. So ask us the question, what happens when I take a project, what happens when I take that difference? The cash flow. See you Monday.